Hi everyone, it's Grace. Welcome back to my channel. There has been a lot of movement in the market since the Fed funds rate has been raised by 25 basis points in March. The bonds and mortgage markets are very reactive to it. And in today's FOMC meeting minutes, there has been talk that the Fed may raise the federal funds rate by 50 basis points and reducing the Fed's balance sheet. And we'll cover more of that later during the week. In last week's video, I talked about whether the yield curve inversion and mortgage rate hike will cause the market to crash. And you can click here to check out that video. By today's video title, I think it's helpful to simulate the scenario so you'll have a crystal clear idea of what it looks like if the housing market crashes by like 50% tomorrow. And afterwards, we're going to look at some of the short-term and long-term risk factors and identify them clearly. Before we begin, remember to subscribe to my channel and click on the bell button so you'll get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. There's often a mismatch between when people have a lot of money in their pockets versus when they want to buy a property at dirt cheap price. If we're using the 2008 era to compare to today, we're currently on April 2004. You're either having a great job, a promotion, a raise, you're saving a lot of money and having a big win in your investment portfolio. In other words, you're having a lot more money than before and a job that brings you continuous cash flow. But when it comes to the housing price trend, we immediately fast forward to July 2008 where the housing price drops by more than 50%. And now you're like, I can finally invest in a property that was like $1 million through the roof, overvalued, ridiculous. Now I can finally purchase it at half the price. This is amazing. The problem with this kind of scenario is that it only exists as an idea. It doesn't exist in a real world. But let's assume that the price does drop by 50% tomorrow. The direct result is that you'll immediately lose your job and the dividends or monthly payments that you receive from your investment immediately stop because the companies that you invest in are bankrupt. And that's not the worst thing. You're losing the most valuable asset that you ever own, your cash flow. Now you only have limited assets, and not all of them are short-term assets that you can quickly cash out. And to make it worse, that's not even the lowest housing price. It'll be 3 more years until it hits absolute bottom. You have to go through 3 years or more without getting a job because businesses are closed everywhere. Now, are you still thinking that an immediate overnight crash by like 50% is a good idea? Or will you still buy the property that you so wanted at $500K? Probably not. The reason why I put these two situations together is because I often compare China with the US as a pair of brothers, because their economies are essentially the same. They're all very heavily intertwined with the development of real estate. When we're looking at a developer crisis led by Evergrande, there are 3 essential economic conditions for it to happen. First, supply is much higher than inflexible demand. The key is inflexible, which is the demand to buy a self-living home, and it doesn't really fluctuate according to the market highs and lows. Second, property developers have very high liabilities to assets ratio. For Evergrande, it was more than 80%. And third, the macro policy to stop offering loans all of a sudden. And for the same criteria, this is where the US is at right now. The first one is that supply is much lower than inflexible demand. And second, residential mortgage has very low liabilities to assets ratio, but the ratio in a wholesale mortgage could be higher. And the third one is that the macro policy follows the market, and a dictatorial policy is very unlikely to happen in a market economy. The only situation that a housing price will crash by like 50% is if the Fed acts exactly like Paul Volcker back in the 1980s, which I really doubt it's going to happen. So as you can see, the US is now in 2004 and China is in 2008. I'm not saying this is exactly where we are at right now because the actual timeline will have to depend on monetary and fiscal policies. But we're at least 4 years apart in the simulation. Right now in the US, people have actual needs to buy properties. But right now in China, no one buys cars, no one buys houses, and no one takes out loans from the bank. So first, because of these economic conditions, it's physically impossible for the housing market to crash by like 50% in the US right now. And second, a policy that cuts off all loans in China will never happen in the US. There's a progress to go to the level where China is at right now, and I hope that we never get to the point where it's out of control. I think it's extremely valuable to see what's happening in China right now because we can see it with our own eyes. If there's no comparison, how do we know what the next housing crash may look like? We know when that eventually happens to the US, it's probably going to be the same. But the two countries are several years apart in economic development, and this is the time for wealth accumulation. If you want to make and store a lot of money, this is the time to do so. Because when the US arrives at where China is at today, it'll be a long winter that you'll need to store a lot of fat to survive through. This is just to show you what kinds of industries will be impacted. Remember, your everyday bill is the cash flow income for businesses in the market. As the bonus tip for today's video, I'll point out a major risk factor that could shift the second economic condition that we mentioned before, the liabilities to assets ratio for wholesale mortgage or corporate loans. As usual, I'll use the chart to explain. There are together 6 rates. Yellow is the Fed funds rate, blue is the prime rate, green is the 30-year fixed mortgage rate, purple is the 48 months new auto loan, orange is the 24 months interest rate on personal loan, and red is the credit card loan. You can clearly see that these rates come in a hierarchy where the Fed funds rate is the basis for everything else. So based on the Fed funds rate, there's the prime rate, which banks lend to their most creditworthy corporate clients. And all these short-term interest rates are based on the prime rate. Since the prime rate moves exactly like the Fed funds rate, usually 3% above it, when the Fed funds rate moves up, the prime rate also moves up, and so are the other interest rates. So we're seeing not just higher mortgage rates, but also higher interest rates in getting personal loans, auto loans, credit card loans, etc. One interesting thing I discovered is that the 30-year fixed mortgage rate went below the prime rate when the Fed funds rate reached a peak from the period of 2005 to 2008 and the period between 2017 and 2020. That tells you a recession happened during those periods. But when we go back to 2009 and 2015, the mortgage rate was higher than the prime rate, which is what those two rates should be. I think the mortgage rate goes even below prime rate is probably the reason why so many institutional investors decide to heavily invest in real estate. Technically, they can use the prime rate to get a corporate loan at 3.25%, but the mortgage rate was even lower at 2.65%, and that's not quite normal. I suspect that they use the wholesale mortgage to take out loans at 30-year fixed mortgage rate level rather than the prime rate. Because they overbid 30, 40, 50% over asking price to buy hundreds of thousands of homes all at once, those wholesale mortgages are ballooning very fast. As I mentioned before, the LTV levels and foreclosure rates in the individual residential mortgage markets are very low. So the risk factor is not in the individual mortgage market, but the wholesale mortgage market. Now that the mortgage rate shoots above the prime rate after the first Fed rate hike, it'll significantly slow down the buying behavior of institutional investors. That'll be a trigger for the housing price to slow down, especially in areas that they heavily invest in. So this is a major risk factor that's brewing in the US financial system, and it shouldn't be ignored. So this is today's video about what happens if the housing crash by 50% tomorrow and the identification of a major risk factor. I hope you find it useful. As always, thank you very much for watching, and I'll see you on the next one.